Hey everybody, Dave here, Hidden Freedom Investing. In today's video, we're going to go over ExxonMobil's Q3 earnings for 2020, kind of compare that against Q2, also look at the outlook for Q4 2020, and also even look at 2021, see where they're going, and make sure that the company is healthy and the dividend is safe. So let's go ahead and get started. The information expressed in this video is my opinion and my opinion only. This information is for entertainment purposes only. Please do your own research. All right, we're looking at the earnings for Q3 of 2020. We're going to compare them against Q2. I did a video on Q2's results as well and kind of talked about a bunch of stuff in that video. So if you want to take a look at that video, you can look at it up here. And I'm not going to go over as much detail in this video, which will keep it a little bit shorter, but that's all we really care about is the numbers. So if you want to learn a little bit more about ExxonMobil and all that, you can watch that video. So Q3 2020, we had a total revenue of $45 billion, almost $45.4 billion. And as compared to last quarter's $32.2 billion, that's a substantial increase in revenue there. Total operating expenses there went up as well, $46.2 billion compared to last quarter's $33.9 billion. I guess the big one there to note is probably the cost of revenue there went up substantially. We got total income or operating income of about $800 million, and that was compared to last quarter's about 1.6 billion. So that got halved there. We scroll on down here a little bit. Looks like we had net income of $680 million. That was actually minus $680 million compared to last quarter's of a minus about $1 billion or so. And scrolling down here, it looks like they paid out about $3.7 billion in dividend, which is consistent with what the last quarter was as well. And we'll look at the assets here. Let's see, cash and short-term investments, $8.8 billion for Q3 of 2020 compared to last quarter's $12.5 billion. And let's see, total assets, $358 billion compared to last quarter's $361 billion. And scrolling down here, let's just look at total liabilities, $180 billion, and that was for this quarter. And that was compared to last quarter's $181 billion. So relatively the debt to asset ratio is about the same as it was last quarter, which is about 50% or so. That had been going up pretty substantially, and it looks like from Q2 to Q3 it remained about 50%, so that looks good so far. Development since second quarter of 2020 upstream, we got liquids realizations increased significantly, offsetting lower gas realizations mainly due to liquid natural gas price lag. Let's see, all economic curtailments back online. Government mandated curtailments of 140 KOEBD, which I think stands for thousands of oil equivalent barrels per day or something like that. That's an oil industry term, and I'm not, don't quote me on that, but I believe that's what it is. Achieved best ever safety performance despite pandemic challenges, best reliability since 2015. Yes, that could be a challenge just given that they had to probably cut workforce, and I know that they did for a fact, cut the workforce across the whole world, various parts of the world, I should say. And when you got less people on board, it means there's going to be some more mishaps, most likely. Guyana, and let's see here, achieved with government approval of the development 2 additional discoveries. I think they're talking about yellowtail and redtail. Downstream achieved best reliability, process and personnel safety performance for the last 10 years. And it's just like what we talked about up there. When you start cutting workforce, you're going to have more mishaps most likely. Refining margins decrease with continued excess industry capacity and higher product inventories. Chemical, which is kind of remains the same as what it was last quarter. Industry leading safety performance, strong reliability underpinning growth and earnings. Sustained packaging and hygiene demand. improve automotive and construction markets. So that actually remains where it was last quarter as well. We had a lot of pandemic packaging, or whatever you want to call it. So there's an increase a demand for packaging and hygiene. So they did see a better development there. Corporate, see capital spending further reduced by $1 billion, greater than 20% for Q1 for 2020. Signed agreement with Global Clean Energy Holdings to broaden distribution and renewable diesel. Expanded agreement with Global Thermostat to advance and scale direct air capture technology. Driving OPEX efficiencies, we did talk about that last quarter. On track to exceed reduction target, maintaining safety and operations integrity spend. Let's see, cash operating costs reduced 20% versus Q3 of 2019. Reorganizations driving structural improvements, optimizing supply chain, logistics, and execution. We talked about that last quarter as well. Reduce workforce, we talked about that last quarter as well. Work process simplification. All those things are going to drive efficiencies and drive OPEX efficiency, which should make them more money in the long run. Optimizing maintenance spend as well. Driving CapEx efficiency, on track to exceed reduction for capital spending. So year-to-date CapEx of $17 billion, reducing CapEx through pacing of short-cycle, unconventional exploration activity and downstream chemical projects, leveraging market environment to offset deferral costs. And we did talk about that last quarter as well. They are cutting back on CapEx substantially, and they're putting a lot of their capital towards high yielding investments, and we'll kind of talk about that here in a second. Liquid supplies demand balancing recovering, so looks like there's a pretty big substantial recover since Q2 of 2020. So demand increased by 13% versus Q2. And supply decreased by 1% versus Q2. Now, they did talk about that on the earnings call, so that's kind of interesting. Kind of learned something new about the oil industry, but we'll talk about that a little bit later on. Q2 2020 inventory levels decreased by 200 million barrels, and like I said, we'll talk about that here in a minute as well. Expect continuing recovery in demand, so that's good. That means that people are going to be driving more a little bit. I think 45% of a barrel, an oil barrel, goes to passenger cars and just fuel in general. So you got the small gas engines and stuff like that, and I think about 9% goes to airlines, and you got diesel, and you got heating oil and all that stuff in there as well. You got plastics that need to be made, but airlines have not come back yet, so that's probably where they're getting a big hit. Transports are coming back, probably faster than any of the other industries at this point, including passenger cars, which I haven't been driving any more now than I was 6 months ago. So let's go ahead and look at some of the positives for ExxonMobil going forward for Q4 of 2020, and also look at for 2021 as well. Industry investments are down, so that means just in general, we're not talking about just ExxonMobil here. Industry investments are down. That means they're not exploring more, new opportunities, new locations for barrel producing locations or anything like that. Which means it's a 5-year decline in supply development spend. What does that mean? That means that most likely what's going to happen is demand's going to end up going up. And they did talk about that in the earnings call, and that's something I kind of learned that was kind of new, so that was interesting. I always thought that an oil producing site would just produce oil for the rest of your life. I had no idea that there's this limited amount of supply at those locations. So I guess there's only so many dinosaurs that died at a location, and pretty much once the dinosaurs are yanked up, they're gone. So we get the margin environment here, refining margins at historical lows, driving increased rationalizations, chemical margins near bottom of cycle, increasing number of projects deferrals and cancelizations, industry supply capacity reductions expected to improve margins. It's just everybody's cutting back. And I mean, that doesn't have to do all with COVID or anything like that. It could have been the government, the good old government there cutting back as well, or telling them to cut back. OPEC cutting back. In this case here, ExxonMobil had to cut back as well. If there's just not as much demand, they need to cut back expenses as well, CapEx, OpEx, and reduce expenses. So they're cutting back, and they haven't seen this much cut since what? It's been 5 years or so. Looks like ExxonMobil is righting the ship. Go ahead and like and subscribe and hit that bell notification. Looking to 2021, manage near-term constraints while positioning for recovery, maintain record safety and operational performance. They keep mentioning that. Must be a big deal. Sustain OpEx reductions and advance further structural efficiencies. Continue to pace capital spending while preserving value. Expect 2021 CapEx of 16 to 19 billion. Increase emphasis on high grading asset portfolio, maintaining capital allocation priorities. Driving reductions in spend, reorganizations allow step change in efficiency and improved responsiveness. Better line of sight to work process improvements. Work to date delivering 15% workforce reduction, which I think they just announced last month that they're going to be reducing some of jobs here, I believe in the Houston area. So 1,900 jobs or so here in the US. So I think even last quarter they were talking about Australia and maybe Europe as well. And now they're starting to hit the US a little bit. Optimizing spend while maintaining safety and operational integrity, driving cost reductions and maintenance, logistics and supply chain. So they're still trying to find some efficiencies there. Global projects organization, optimizing project execution pace and spend, maintaining execution of corporate project portfolio improvement prioritization, coordination and optimization, single interface with contractor community. So they did talk about prioritization of higher value investments, progressing Guyana development, 750K barrels per day by 2026, maintaining exploration activities in Guyana and Brazil. This is Brazil. Okay, that's my Fast Five and Vin Diesel impression. So pacing short cycle Permian growth. And let's see what we got here. Downstream chemical. Progressing steam cracker projects in China and Texas. What the heck is a cracker? I think that is an industry term for a plant that produces ethylene. So it's not a ExxonMobil term. I believe it's an oil standard term for a plant that produces ethylene, which is I think for plastics. Corpus Christi cracker under budget and ahead of schedule. Startup timing and remaining downstream and chemical projects paced to 1 to 3 years. Capital allocation priorities. Long-term capital allocation priorities remain unchanged. Invest in advantage products or projects. All right, that's the Guyana, that's the Brazil. All right, and a Permian as well. Maintain strong balance sheet. Provide reliable and growing dividends. So they did talk about that quite a bit on the earnings call. That is a big priority for them. Developing 2021 plan consistent with near-term demand uncertainties and commitments. Reducing CapEx to 16 to 19 billion dollars. Further reducing cash operating expenses. Focus on overhead. Maintaining dividend without increasing gross debt levels above Q2 2020 levels. That's when they took on that debt there. Maintaining flexible and respond as market evolve. All right, so we talked about the numbers here, and so that was I think the earnings came out like right around here or so, and it popped up a little bit. Obviously they maintained the dividend, which we'll talk about here in a little bit as well. This little pop-up right here was from the election. Now the election actually was here, and I think the results came out a couple days later that President-elect Biden was going to be in office, and probably the real thing that really set this off was probably the fact that we're going to have divided government, because I don't think that Biden is for big oil. So that wouldn't really make it pop up in my opinion. But anyway, since then we've gone all the way up to just above 40 here. We've stuck at that 200 period moving average. And right now this is a $174 billion company. We pay a dividend of 8.5% That was a substantial decrease from last quarter, about a little over 10%. So 74,000, almost 75,000 employees. Now they're reducing that slightly, or reducing some contractors as well. Forward PE is 28, still an expensive company given the price of the stock at $40, which is down 41% on the year. So hopefully they start increasing the profit margin, and the price should go up. The forward PE should go down. So looking at Seeking Alpha here, we got the dividend yield of 8.5%. Payout, let's see, annual payout $3.48. They're not even showing the payout ratio in here. 5-year dividend growth of 4.9% there. And dividend growth, which is actually, I think, right at 38 years consecutive dividend payouts. The funny thing is the last quarter showed 19 years here. So looking at the dividend information in Schwab, we got, let's see here, just went ex-dividend on November 10th. It's going to pay out on December 10th. It should be paying out 87 cents, so that's an annual payout of $3.48. They did not raise the dividend, which I kind of thought they were going to do, but I was mistaken. If you watched my last video, I was mistaken in there, and we'll kind of correct that in this video going forward. Let's see, regular dividend, 87 cents. They pay quarterly, obviously, and this shows the dividend payout ratio of 576%, which I actually think is correct. If we look at the actual earnings EPS here, so we add all these up here and see GAAP 115. Let's go ahead and just calculate that out. So we got 116 plus or minus 0.14, minus 0.25, minus 0.16, and it comes out to 61. So we got 61, and let's see here, 3.48 divided by 0.61. Excuse me, 3.48 divided by 0.61. My 6 key is not working. And that's, let's see, times 100, 570%. So I believe that FinViz is actually wrong, and I believe that Schwab is actually right, 570%. But that should be actually coming down because they actually are increasing the efficiency of the company as well. So the profit margin should go up, and so should the earnings. So I believe that I believe this will probably be the last quarter for this payout ratio to be that high, in my opinion. So what does my portfolio look like? Last quarter I told you that I was going to buy more, and I actually did. So let's go and take a look at my portfolio here. And this is my dividend portfolio. Let's see here. Here's ExxonMobil right here. These are all my dividend stocks. I do a dividend review video every single month. If you want to take a look at that, you can look at it up here and pretty much go through my whole dividend portfolio, the dividends received and all that. But anyways, we are going to look at ExxonMobil here. I substantially increased this position. I actually doubled this position this quarter. So I think last quarter I had about 115 shares. Now I got 223 shares. I was down 40% last quarter, the last video, and now I'm only down 10%. So I did increase my position substantially in ExxonMobil. I actually did buy a little bit of Chevron as well. So we are sitting at minus 10% and an average cost of about $44.88 across my two accounts, because this is a taxable and a tax deferred account. It also did increase my allocation for energy up to 5.6%. I don't really want to go any higher than that. That was a substantial increase from where it was last video. Energy 2%, that's the target of where I want to be, but I figured that this is such a good deal. Oil going forward down, this is like a 5-year low, and it just couldn't be sustained, so I went ahead and bought some shares. So scrolling over here, let's see here, my yield on cost is a 7.75%. It pays 8.66% at this time. This payout ratio is wrong, which is derived off of Google's EPS, which I think is still wrong. So Google's EPS is showing 0.78, which is actually wrong, I believe. So that needs to be updated. 37 years, so Seeking Alpha had it at 38, so it's somewhere around there, 37, 38 years. ExxonMobil is maintaining the dividend. Go ahead and like and subscribe and hit that bell notification. So looking back here at Schwab, we see the dividend here. Now last video I said they needed to increase it by the end of the year. So looking at the dividend history here, it looks like the last time they increased their dividend was early 2019, so 82 cents to 87 cents. They haven't increased it since then, which means I thought they needed to increase it this year, at least, probably in December, which, I mean, that's actually not right. One of my subscribers pointed that out, that I made a mistake there. There's two theories behind that they actually need to increase it at least once a year. Now, granted, that could almost still give them almost 2 years, right? If they increase it in January of 2019 and they increase it in December of 2020, that's almost 2 years there that they have to increase it, right? But that's actually wrong as well. All right, so the other theory is that they just has to, the amount cumulative for that year needs to be more than it was for the last year. All right, so because they increased it last year, and that means that they can go all this year without increasing it and literally go all the way until December of 2021 before they have to increase it. All right, so that's almost 3 years they can technically go before they have to increase it. All right, they only have to increase it by 1 penny as well, and that'll count. And the only way to prove that theory is to look at other stocks going back. I think he pointed out Leggett & Platt was a good example. Leggett & Platt would not be a dividend king off of my theory, where they have to increase it every single calendar year. But going by his theory, Leggett & Platt is a dividend king. So I appreciate him for bringing that up, and going forward, I'll apply that logic. So ExxonMobil, it looks like they are turning things around. They're righting that ship, right? That's getting powered by ExxonMobil diesel, of course. And airlines are coming back slowly. Passenger cars are coming back slowly. Packaging and then all those plastics and materials kind of was already strong to begin with. They already took enough debt out last quarter to take them through all of next year as far as the dividend is concerned. Somebody brought that up on the actual conference call and said that they are, that the income that they're making is not sustainable for the dividend. So they're like, what would make you have to cut the dividend? And they said, we're pretty much good through 2021. And obviously they said, the guy pressed them even more and said, what would require you to actually lower the dividend? And they said, well, if we go back to Q2 levels, Q1 levels, the pandemic comes back and oil demand declines and all that, then obviously they might have to take more debt out, or they have to consider cutting the dividend. But right now, it looks like the dividend's safe all the way through 2021, most likely, because I think things are going to continue to improve as well. We already saw it here from Q2 to Q3. So things are improving, demand's improving. One of the things they mentioned on the conference call that I did not know is the spending on exploration and all that has hit a 5-year low. So that automatically is going to drive demand up as well. So that's industry-wide, okay? In addition to that, I think by 2040, there's still already going to be a demand increase by 25%. And I talked about this on the last video. That doesn't matter whether EV is going to be taking over the passenger industry or not. It's going to take a long time for that to happen. There's still going to be a demand increase by 25%. And we're already seeing a demand increase now because they need to catch up with the exploration at this point. They're already behind and the industry's behind. So that means there's going to be a demand increase just from that alone. So with all these things combined, dividend safe, looks like things are turning around, and I'm glad that I purchased more. So if you have any comments, questions, or concerns, go ahead and leave a comment below. Go ahead and like and subscribe, and we'll see you in the next video. Thanks for watching.